On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So, before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi, team. Hope you're all doing well, taking it easy, looking ahead to a well deserved long weekend over the Easter break. I wanted to talk today about tax, and let me just say from the outset that I'm not an accountant, I'm not a tax expert, and I'm certainly not a tax advisor. So if you're after some specific guidance about how to structure your affairs, your investment portfolio, or anything like that, you need to go and talk to a professional. You won't get the answers here. But what I do want to talk about is the fact that if you hold some of your investments in a trust or all of your investments in a trust, your tax rate is going up from next week. And that means you might need to rethink the types of assets you own and the investment vehicles you choose to get exposure to those through to ensure that you're not paying any more tax than you need to. However, we should also be aware that the tax impost we might face might not be the showstopper that some are suggesting it will be. And it doesn't always make sense to build an entire investment strategy around tax minimization. So, fine tuning could be the order of the day rather than a complete recalibration of your approach. From April 1, which is next week, the tax rate for trustees will increase from 33% to 39%, and that will apply to all trusts with income over $10,000 a year. And this tax hike will bring the trust tax rate into line with the highest personal tax rate, which is also 39%. What people are expecting is that investors who own their assets in a trust will probably move some or all of those investments into portfolio investment entities, PIEs, because PIEs attract a maximum tax rate of 28%. It's capped at 28%. There's obviously quite a big difference between 28 and 39. So people are moving on to 39 might want to limit their tax to 28%. So they might sort of look to make those changes. Now, almost all of the unlisted managed funds in New Zealand are PIEs, KiwiSaver funds, and other sorts of managed funds. And some of the listed vehicles on our share market are also PIEs, such as the real estate entities, Goodman Property Trust, Precinct Properties, Property for Industry, and so forth. So, moving some of your directly owned trust assets, like your fixed income, like your shares, into a PIE vehicle that provides you a similar type of exposure will indeed save you some money on your tax bill. So let's run through a few back of the envelope estimates of what that might mean. Let's keep in mind that New Zealand doesn't have a capital gains tax for the most part, and that means that it's only income which attracts the ire of the taxman, the IRD. So you only get taxed on the income. Now, if we run through some of the main asset classes, and I won't cover everything, we'll just do a few of the major ones. Cash, term deposits, and fixed income, assuming you hold it to maturity rather than sort of buying and selling your fixed income or your bonds. So we'll just keep it simple. Those things only generate returns via income. So all you get is the interest rate or the coupon. That's the only way you get a return. And that means in some ways, those assets will feel the brunt of higher taxes the most. Now, if we use the 5-year government bond yield, which has averaged 4.8% over the past 3 decades, the past 30 years, if we use that as a guide, the after-tax return improves from 2.9% to 3.5% if you can reduce your tax bill from 39% to 28%. Now, while that's only marginally above 0.5% per annum, it's a decent proportion of the overall return because the overall return was only 4.8% to start with. So 0.5% is actually quite a big chunk of that. When it comes to shares, things start to get a little bit murkier. New Zealand shares have delivered an annual total return of 8.6% per annum over the past 30 years. And that increases to a little more than 10% if you account for imputation credits and add those back in. Imputation credits are the credits you get when you're paid a dividend so that you don't have to pay tax a second time on the profits that the company in question has already paid. And not every company pays tax or pays full levels of tax. So you don't get full imputation credits across the board. But for the most part, most dividends will be either fully imputed or close to it. So New Zealand shares, when you add those tax credits back in, have delivered a little more than 10% per annum. And actually, there's only 2 or 3 countries in the world that have that sort of regime. We're one, Australia's another. They have their franking credits, same thing, different name. And I think there's another country out there that also uses that approach. And what it means is that New Zealand shares for New Zealand investors are incredibly tax efficient because you get that level of imputation that gives you a bit of a tax shield. So, anyway, a little more than 10% per annum over the last 30 years from New Zealand shares. Now, about 40 odd percent of the return has come from share price gains, which are untaxed. So, tax rates changing won't have any impact on that portion of your return because it's not taxed anyway. So, it doesn't matter what the rate is. And the majority of the return, so the other 60 odd percent, has been from cash dividends. So when you tax those dividends at 39%, the annual tax drag overall is about 2.6%, right? So it's sort of 8.6% is what we started with. 60% of that has been dividends, 39% of that has been tax, equals 2.6%. And that means the total return falls to about 7.4%. I'm adding back the imputation credits again because those are important. So at the lower pie tax rate of 28%, the tax drag is 1.9% rather than 2.6%. So that means the total return on the New Zealand shares, remember you started with a little more than 10, at 39% you ended up with 7.4. At the 28% pie tax rate, you go from slightly more than 10 to 8.2. So there's a savings there of about 0.75% from moving your New Zealand shares from that 39% tax rate sort of trust structure into a 28% pie structure. So 0.75%, nothing to be sneezed at. That's quite a bit per annum. However, there are other things to keep in mind too, and one of them is that investment portfolios don't manage themselves unless you've got the time to manage it yourself. You usually have to pay someone to do that, and there are a lot of ways that you can have someone look after your investment portfolio, but managed funds are at the more expensive end of the spectrum when it comes to fees. And I went on the Sorted website, which is sort of the government's used to be the Retirement Commission website, very useful website. And I looked at all the growth funds, all the growth managed funds, and the Sorted website told me that the average growth fund charges total fees of just shy of 1.5% per annum. So you've got to keep that in mind. You might be saving 0.75%, but if you're attracting fees of certainly north of 1%, maybe as high as 1.5%, then potentially everything you're saving in taxes might be getting wiped out by the additional fees that you're paying. So just make sure you're looking at all the elements of the puzzle there. So that's New Zealand shares. Probably do face a higher tax burden because of these changes, because of that greater income component. But of course, it all depends. If you're investing in shares that have a more growth focus, then you will be shielded more because a bigger portion of your return would be coming from share price changes over time, and that is obviously untaxed. So it all depends, but I'm just using the market overall. Anyway, moving on. International shares, now they are taxed differently, and for most investors, whether you're a private investor or whether you're a pie fund, for most investors, they will be taxed using what they call the fair dividend rate method. It assumes a deemed dividend return of 5%, just a flat 5%, and investors will pay tax on that 5% at their marginal rate. Even when the market goes up 25 or 30% like it did last year, you'll still only pay tax on the 5%. So the tax drag or the tax impost on a fixed 5% return at 39% is obviously 2%. 39% of 5% equals 2% or just under. So that's what your tax would be if you're on the 39% tax rate. If you can reduce that tax rate to 28%, then 2% turns into 1.4 using a pie. So the difference there is just above 0.5%, 0.55% to be precise. So that's not hugely significant or not as significant relative to the average return that we've seen from US shares. As an example, over the past 3 decades, US shares have delivered 10.1% per annum over the past 3 decades. So if your tax drag is, call it 0.5%, it's not a showstopper, it's not a game changer, but using a pie structure can be an excellent complement to directly held investments, especially for people that are looking to minimize tax for the parts of the investment landscape where it makes sense. Now, any good investment advisor will have a range of tools and options at their disposal to satisfy those investors who want to use pies exclusively across the board, as well as people who want only direct investments. And for the majority of people that are in this situation, I suspect a combination of both, because there are opportunities to mix and match and use different approaches for parts of the portfolio where it makes the most sense. So I think it is really important that we think about some of these issues. Always important to be tax aware and to minimize costs, whether it's fees, whether it's taxes, wherever you can. But you've also got to make sure that you do take a holistic approach. Fees are an obvious consideration. Another one is the flexibility that you might lose if you're only using pies. If your whole portfolio is just these 6 managed funds, then you've immediately taken away that ability to have some influence or say about how your investments are managed, what your sustainability goals are, and how you meet those. So you are giving up the ability to tailor your portfolio to your needs, and you're giving up that flexibility. But still lots of opportunities to ensure that you can structure your affairs in a way that will give you the best return for the lowest amount of tax and the lowest amount of cost. So whether you've got a trust or not, I think it is a really opportune time to take a closer look at how your affairs are structured. But the word of warning that I mentioned earlier is don't let tax considerations alone drive your investment decisions. All right, thanks, team. Thanks for listening. We'll talk again soon.